Financial statement analysis. Basics of financial statement analysis. Need for comparative analysis. 1. Intra-company basis. 2. Industry averages. 3. Intercompany basis. Horizontal analysis. Balance sheets. The comparative balance sheet in illustration show that a number of significant changes have occurred in quality department stores financial structure from 2008 to 2009. In the asset section, planned asset increased 167.500 or 26,5%. In the liabilities section, current liabilities increased 41.500 or 13,7%. In the stockholders' equity section, retained earnings increased 202.600 or 38,6%. This change suggests that the company expanded its asset base during 2009 and financed this expansion primarily by retaining income rather than assuming additional long-term debt. Income statement. Horizontal analysis of the income statement show the following change. Net sales increased 260.000 or 14,2%. Cost of goods sold increased 141.000 or 12,4%. Total operating expense increased 37.000 or 11,6%. Overall gross profit and net income were up substantially. Gross profit increased 17,1% and net income 26,5%. Quality profit trend appears favorable. Retained earnings statement. Analyzed horizontal, net income increased 55.300 or 26,5%, whereas dividends on the common stocks increased only 1.200 or 2%. We saw in the horizontal analysis of the balance sheets that ending retained earnings increased 38,6%. As indicated earlier, the company retained a significant portion of net income to finance additional planned facilities. Horizontal analysis of change from period to period is relatively straightforward and is quite useful, but complication can occur in making the computation. If an item has no value in a base year of preceding year but does have a value in the next year, we cannot compute a percentage. Similarly, if a negative amount appears in the base or preceding period and a positive amount exists the following years, or vice versa, no percentage change the be computed. Vertical analysis. Balance sheets. Vertical analysis shows the relative size of each category in the balance sheets. It also can show the percentage change in the individual assets, liability, and stockholders' equity items. For example, we can see that current assets decreased from 59,2% of total assets in 2018 to 55,6% in 2009. Even though the absolute dollar amount increased 75,000 in that time. Planned assets have increased from 39,7% to 43,6% of total assets. Retained earnings have increased from 32,9% to 39,7% of total liabilities and stockholders' equity. This result reinforces the earlier observation that quality is choosing to finance its growth through retention of earnings rather than through issuing additional debt. Income statement. Cost of goods sold as a percentage of net sales declined 1% and total operating expense declined 0,4%. As a result, it is not surprising to see net income as a percent of net sales increase from 11,4% to 12,6%. Quality appears to be a profitable business that is becoming even more successful. An associated benefit of vertical analysis is that it enables you to compare companies of different size. For example, Quality's main competitor of a GC Penney store in a Bernie town. Using vertical analysis, we can compare the converted income statement of Quality department store INC. Ratio analysis. Liquidity ratios. 1. Current ratio. The current ratio is a widely used measure for evaluating a company's liquidity and short-term debt-paying ability. The ratio is computed by dividing current assets by current liabilities.
Asset test ratio. The asset test ratio is a measure of a company's immediate short-term liquidity. We compute this ratio by dividing the sum of cash, short-term investment, and net receivables by current liabilities. Thus, is an important complement to the current ratio. Receivables turnover. Assume that all sellers are credit sellers. The balance of net receivables at the beginning of 2008 is $2,100. Illustration shows the receivables turnover for Quality department store and comparative data. Quality's receivables turnover improved in 2009. The turnover of 10.2 times is substantially lower than GC Penney's 37.2 times and is also lower than the department store industry average of 46.4 times. Inventory turnover days in inventory. A variant of inventory turnover is the days in inventory. We calculate it by dividing the inventory turnover into 365. For example, Quality 2009 inventory turnover of 2.3 times divided into 365 is approximately 159 days. Profit margin. Quality experienced an increase in its profit margin from 2008 to 2009. Its profit margin is unusually high in comparison with the industry average of 8% and GC Penney 1.4%. Asset turnover. Asset turnover measures how efficiently a company uses its asset to generate sales. It is determined by dividing net sales by average assets. The resulting number shows the dollars of sales produced by each dollar invested in assets. At least seasonal factors are significant. We can use the beginning and ending balance of total assets to determine average total assets. Return on assets. Qualities return on assets improved from 2008 to 2009. It is return of 15.4% is very high compared with the department store industry average of 8.9% and GCP's 2.4%. Return on common stockholders' equity. Another widely used profitability ratio is return on common stockholders' equity. It measures profitability from the common stockholders' viewpoint. This ratio shows how many dollars of net income the company earned for each dollar invested by the owners. With preferred stock, when a company has preferred stock, we must deduct preferred dividend requirements from the net income to compute income available to common stockholders. Earnings per share. Note that no industry or GCP data are presented. Such comparison are not meaningful because of the wide variation in the number of shares of outstanding stock among companies. Price-earnings ratio. In 2009, its share of quality stock soared for 12.4 times the amount that the company earned on its share. Quality price-earnings ratio is lower than the industry average of 21.3 times and also lower than the ratio of 17.2 times for GCPenney. Payout ratio. Quality payout ratio is higher than the industry average payout ratio of 16.1%. GCPenney's ratio is very high because its net income in 2009 was quite low softly ratios. Debit to total assets ratio. A ratio of 45.3% means that creditors have profit 45.3% of quality department store's total assets. Quality 45.3% is above the industry average of 34.2%. Time interest earned. Not the time interest earned used income before income tax and interest expense. This presents the amount available to cover interest. Earning power and irregular items. Discontinued operation. Discontinued operation refers to the disposal of a significant component of a business, such as the elimination of a major class of customer or an entry activity. Extraordinary items. Extraordinary items are events and transactions that meet two conditions. They are unusual in nature and too infrequent in occurrence. To be unusual, the item should be abnormal and only incidentally relates to the company's customary activity. Change in accounting principle. A change in accounting principle occurs when the principle used in the current year is different from the one used in the preceding year. Accounting rules permit a change when management can show that the new principle is preferable to the old principle. Comprehensive income. Comprehensive income includes all changes in stockholders' equity during a period except those resulting from investment by stockholders and distribution to stockholders. A number of alternative formats for reporting comprehensive income are allowed. These formats are discussed in advanced accounting course. Quality of earnings. alternative accounting methods. For example, if General Motors Corporation had used FIFO instead of LIFO for inventory valuation, its inventories in a recent year have been 26% higher, which significantly affect the current ratio or another ratio as well. Pro forma income. Pro forma income usually excludes items that the company thinks are unusual or non-recurring. For example, at one time, Cisco System or high-tech company report the quarterly net loss under GAAP of 2.7 billion US dollar. Improper recognition. To illustrate, Bristol Myers Squibb at one time indicates that it used sales incentives to encourage wholesalers to buy more drug than needed to meet patent demands. As a result, the company had to use revised financial statements showing correct revenues and income.